Well, strategists project another bullish year for U.S. markets. Investors should also be looking beyond domestic equities so as not to miss out on the opportunities lying within the international arena. Portfolio manager of the Parnassus International Equity Fund, Ken Ryan, joins us now to discuss. Ken, it is good to see you. So, it's a new year, Ken. Maybe I'm looking over my portfolio. Why do I want exposure to international markets, Ken, in 2026 and beyond? What are the big picture reasons?
Yeah, well, thanks, Josh, and really glad to be here. I'll start with the big reason, which international markets were up 30% last year, over 30%. Let that sink in for a minute. Notably outperforming the S&P, and what were really the key drivers of that? Very important to understand. It's a variety of themes throughout a number of regions and markets, largely uncorrelated to the U.S. It's the U.S. dollar weakening, and that helping a lot of global companies. And it's starting valuations in general and internationally being a lot lower than the US. And for US-centric investors who oftentimes tend to focus on their home market, tend to focus on the Mag 7, tend to ignore some of these opportunities globally, we think this is very good opportunity. Start of the year, everyone revisits their portfolios, and we have a lot of themes we're excited about, and we really want to make a lot of investors a lot more aware of what's going on in the rest of the world.
What are some of the wild cards, though, Ken, I might need to consider before deploying capital overseas? I mean, would it be, is it geopolitical tensions, Ken? Is it tariffs? Is it rates? Walk me through the broad risks you would see.
Yeah, absolutely. Well, I think, Josh, this is a very important reason to look to an active equity manager and look to a professional manager to watch all the trends. I mean, if I look at the index that we track, there's well over 25 different countries around the world. To your point, there's many geopolitical tensions going on. There's interactions with the US in a variety of regards. However, there's also a fair number of opportunities, and we tend to look at the opportunities. We tend to focus on the opportunities. We balance those with the risks. And if you look at Europe, for example, this is a region that we're just so excited about the infrastructure. And the infrastructure build not only over the next year, but over the next decade. This is energy transition, rising electricity demand. This is Europe broadly, led by Germany, planning to spend over €1 trillion over the next decade building out infrastructure. And there's not only a number of sectors, utilities, industrials, materials, but also a lot of specific companies that get us really excited about the region.
On sticking with Europe, Ken, this was interesting. You point out European banks have outperformed, actually, the Mag 7 over the last few years. What explains that, Ken? Is that sustainable? And what's a smart way to play that, in your opinion?
Yeah, absolutely. You took my stat, Josh, so I appreciate you highlighting that one. So I think the story largely with European banks is you almost had a lost decade from 2010, 2009, all the way through really to 2022. Rates were near zero for most of that period of time. Regulation was incredibly high on these banks, and they took a lot of hits in the global financial crisis. You've seen now 3 full years going into year 4 of a lot of that reversing, and these banks starting to benefit from a lot of that pain they took over a 10-plus year period. Rates have gone up. These banks are being run lean and efficiently, and they're being very diligent with their capital, very friendly to shareholders. So what you're seeing, return on equity, is a measure we follow very closely for a lot of the banks. You've seen a lot of these banks over the past 3-4 years move from mid-single digit, maybe high single digit rate on returns on equity to mid-teens for most of them now, and even trending into the high teens. We're really focused on quality here at Parnassus. And look, if someone told me you have a mid-teens, even high teens return on equity company trading at a low double-digit PE, close to 1 times price to book, those are usually the kind of companies we want to look at and potentially own. And there's a lot of banks that meet that criteria.
Ken, let me end here on another thing you point out. Japan, you say at a possible turning point. How so, Ken? Walk me through it. And then how do I want to play that? Is a smart way country-specific ETF, Ken, or no, there are certain specific stocks on your radar?
Yeah, great question. So first and foremost, Japan has been undergoing corporate governance reform. They're now probably in year 4 or 5. But to continue on my previous point of return on equity, most companies you met with in Japan 5, 6, 7 years ago, return on equity was not something they actively talked about. It wasn't something they were putting in their presentations. And you contrast with that today, it's in every discussion. It's in every medium-term plan. It's in every target. And the point behind this is Japanese companies with corporate governance reform, they're focused on returns on capital, they're focused on their shareholder base, and they're focused on running efficient operations and really focusing on their core businesses. And in terms of how to play it, we're bottoms-up stock pickers here. We're big believers that you have to look at the specific companies. You have a lot of management teams in Japan that are saying all the right things to investors, but they're not really following that up with action. And what we're really looking for is not only a management team who says they're focused on return on equity, who says they're focused on their core business, who says they're focused on unwinding cross-shareholdings, but the companies that are actually doing that and showing a lot of evidence. So those are the types of ones we have in our portfolio.
Final one, Ken, I just want to sneak a final name in here. Siemens Energy, I know, is a name you like. Why is that a buy?
Yeah, I think the simple answer with Siemens Energy, you have a highly moated, competitively advantaged business. You have demand as far as the eye can see. Their main business, they're completely sold out of capacity through 2030 and beyond. And you have a structural winner with margin expansion opportunity as this demand comes through. So look, Josh, we're long-term investors, 3 to 4 year average holding period. Some we hold longer than that. Siemens Energy seems like one we can hold for multiple years as the company continues to execute, continues to benefit from increasingly relevant product, and really has a margin benefit as that happens.
Ken, appreciate your time and those picks. Thank you, sir.
Thank you so much. See you later.
Maybe just start right there, Peter. For 2026, you talk about selective opportunity for investors. Walk us through that. How do we discern winners from losers, Peter, against this backdrop? What am I screening for as an investor?
Yeah, absolutely. So thanks for having me on. Stifel's out with our 2026 preview on lifestyle brands. After a challenging 2025, we're eager to turn the page into 2026, and we see valuations at historical lows, and this gives us opportunity to be selective. We see opportunity for those of structurally improving businesses, underappreciated growth models, and those where battered businesses that have opportunity for sentiment re-rating.
You do also, Peter, in the know, you do highlight a theme we talk a lot about on the show, a K-shaped consumer. How does that impact, Peter, where you see opportunity this year?
Yeah, absolutely. The higher income households have been driving spending. We expect that dynamic to persist. So we see the opportunity for brands who have who are bringing performance innovation to scale to the consumer. Those are likely to be advantaged, and the consumer is yet to push back on pricing where they see sufficient value.
What do you think, Peter, margins are going to look like for your coverage universe this year with tariffs still in play here?
Yeah, look, so 2025 tariffs were announced. We're going to get our first full year of tariff impact in 2026. That's a headwind to margins across the space. That means prices are going higher, and on a company-specific basis, companies have the ability to look elsewhere in their P&L to find opportunities to sustain their margins. Margins are going to have some pressure, but we see this as something that we can move past into 2027.
It's interesting, Peter, though, because we're waiting now for this Supreme Court decision. We'll see when we get it. But what if they came out, Peter, and they said, okay, you know what, Trump's tariffs, they're illegal. Have you tried to sort of game out what the ripple effects could be in your coverage universe?
Yeah, the ripple effects from that are the stocks are going up if they throw away the tariffs. I don't think that's a base case scenario. There are other ways for tariffs to be implemented, whether it be through a category or a country of origin basis. So all else equal, I'm considering the tariffs to be in the numbers. I think that's well understood by market participants, and I think stocks are cheap here.
Let's get to some picks while we got you. You like On Holding, stock's down about 10% over the past year. How come, Peter? Why is that one to buy?
Yeah, On is a pure play growth company. This has best visibility to the highest growth rate in all of footwear and apparel. They're going to grow 20% plus. They're winning over customers. They have a new growth driver in Asia Pacific, And this is just a different growth animal. So we see from a low single digit share in footwear, this could move much higher. And with execution, we think the stock goes higher too.
How about Levi Strauss? Now, they're around 85% of analysts on the street like this one. You do too. How come?
Yeah, so Levi is benefiting from a denim trend and a structural move towards higher value businesses. That's women's and their own DTC businesses, their e-commerce and their stores. So we see opportunity for margin and revenue to move higher. The stock's inexpensive, so this thing could move higher.
And finally, Peter, squeeze this one in. Wolverine Worldwide. Now, that stock has slid about 20% over the past 12 months. You think that's an opportunity?
Yeah, so Wolverine Worldwide is in the middle innings of a turnaround. They've fixed their balance sheet problems. They now have the two main brands, Merrell and Saucony. Over 60% of their business are as strong as they've been in many, many years. So we see that as driving the entire income statement higher, with opportunity for revenue growth to inspire higher margins. And from 10 times PE, this could move higher.